Welcome to this explainer. Today, we are doing a pure business reality check on Nvidia, looking straight at the underlying financials and capital allocation. We are framing this entirely around value investing principles, examining the raw facts straight from the ledger to see what is really going on with the underlying business.
We are starting right with the latest news. In a recent Yahoo Finance interview, CEO Jensen Huang confirmed exactly what is happening on the ground. There was an expectation in the market that customers would pause their hardware purchases to wait for the new Blackwell chips. The reality we are seeing is surging demand for current Hopper chips, purely because customers want to deploy GPUs immediately to generate revenue and cut costs today.
Let's dig right into the latest news and facts driving this.
Total revenue surged 262% year over year. Data center revenue skyrocketed 427%. This is absolutely not theoretical demand. Corporations are actively deploying massive amounts of physical hardware into their facilities right at this very moment.
We are observing a fundamental shift to continuous consumption.
The underlying business logic of the entire industry is changing, and this is crucial for a value investing thesis. Early large model development relied on massive, one-off research and development budgets from major tech companies. Once a model is deployed into practical applications, that temporary capital expenditure permanently transforms into continuous, daily AI inference computing.
Every single AI query, automated code generation, and autonomous driving operation requires continuous computing consumption in the background. This daily, rigid usage creates a highly predictable, long-term revenue baseline for the business. Ongoing consumption completely replaces unpredictable research and development cycles. Computing power functions as a permanent consumable in the technology sector.
This brings us to the reality of software switching costs.
Competitors attempting to capture this continuous daily consumption face a severe structural barrier. The obstacle is not a difference in hardware benchmark scores at all. The true barrier is the existing software infrastructure. Millions of AI developers globally, along with mainstream open-source models, are completely locked into the CUDA software ecosystem.
Clients trying to save money by switching to a competitor's chip incur massive time and financial penalties. They must rewrite their core underlying code. Actually, they also have to debug entirely new software architectures from the ground up. They waste months of development time doing this. At the current speed of industry advancement, losing months of development time exposes a business to total obsolescence. High software conversion costs force clients to remain locked in the existing system.
Let's evaluate that capital reinvestment efficiency. The core financial metric for value investors here is return on invested capital, or ROIC. This figure sits consistently above 60%. This is a pure demonstration of mathematical efficiency in capital allocation. Every single dollar of retained earnings reinvested into research and capacity produces 60 cents in net profit the following year. Capital returns compound with extreme efficiency over time.
The expanding scale of the daily inference market provides the exact capacity needed to continuously absorb this massive reinvested capital. The company expands its size while maintaining extremely high capital operation efficiency. Return rates are not diluted at all by this growth.
That leads us directly into valuation and capital allocation.
Capital markets are highly efficient. The commercial certainty and continuous computing consumption expectations we just discussed are completely priced into the current market capitalization. The current share price requires paying a severe premium for these flawless business fundamentals.
Paying a maximum premium carries absolute systemic risk. What happens if downstream tech giants see a slowdown in their AI application monetization?
If downstream companies realize their hardware investments are not generating immediate profits, they face immediate financial pressure. This leads directly to reduced procurement budgets. Any drop in hardware demand causes the current premium valuation to immediately revert to the mean. Shrinking downstream profits directly compress the current share price.
Different pools of capital require strictly calculated allocation strategies based on their specific time horizons. Short-term capital seeks quick returns. Buying into a valuation that fully prices in perfection means taking on extreme risk with zero margin of safety. The logical action here is to avoid.
Long-term capital focuses on asset accumulation. Facing a highly certain, foundational consumable business, the appropriate action is phased accumulation over an extended cycle to consistently lower the cost basis over time.
A final investment disclaimer before we wrap up. This explainer is for fundamental research and personal review only, not direct financial advice. Always conduct independent research based on your personal financial situation. When examining a high-quality but expensively priced asset, how do you plan to balance your capital allocation between a strict margin of safety and long-term structural growth? Think about that. Thank you for joining me for this explainer.